Welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today's episode goes deep into one of the most pressing geopolitical questions of 2025. Will the U.S. withdraw from NATO under Donald Trump's administration? And more importantly, what does that mean for your portfolio? This isn't just a theoretical conversation. The meeting that took place in late February between President Trump, Vice President J.D. Vance, and Ukrainian President Volodymyr Zelensky wasn't just symbolic. It was volatile, it was public, and it was a message. Let's break down the context, explore the market moving implications, and walk through exactly how you can trade the potential fallout. Trump and NATO, where do we really stand? Let's rewind for a second. Back during his first term, Trump made it crystal clear. He saw NATO as a bad deal for the U.S. fast forward to 2025, and nothing's changed, except now he's in power again, with more leverage and fewer guardrails. At the heart of the issue, European nations not pulling their weight on defense spending. According to NATO's latest 2024 report, only 11 out of 32 members hit the 2% of GDP defense target. Trump sees this as the U.S. carrying Europe on its back. And he's not wrong about the imbalance. He's just ready to walk away from the table if it doesn't get fixed. The Oval Office showdown. Here's what raised eyebrows worldwide. A high-stakes, closed-door meeting on February 28, 2025, involving President Trump, VP Vance, and Ukraine's Zelensky. Instead of unity, the room reportedly turned hostile. Vance pushed back hard against continued military aid. Trump echoed him. The U.S. cannot keep footing the bill for European security while our own borders remain unprotected. Zelensky made a direct appeal, stressing Ukraine's strategic role in NATO's future, but the meeting ended with no deal, no aid commitment, and no clarity. That silence? Markets heard it loud and clear. If the U.S. pulls out of NATO, what happens? Let's be blunt, a U.S. exit, or even a partial disengagement, reshapes the entire global security architecture. 1. Massive market volatility. Without the U.S., NATO's deterrent strength plummets. That sends a ripple through Europe, and investors will flee risk-on assets. You'll see sharp outflows from European equities, high-beta currencies, and emerging markets. Safe havens like gold, U.S. treasuries, the Swiss franc, and the yen, they'll catch a bid fast. 2. Defense stocks go vertical. European nations, Germany, France, Poland, will have no choice but to ramp up military spending to plug the U.S. gap. That means a surge in demand for hardware, logistics, surveillance tech. Watch these names: Lockheed Martin LMT, Northrop Grumman NOC, Raytheon RTX, General Dynamics GD, B Systems BS, L, Thales Group HO. 3. Russia and China make moves. Let's not sugarcoat it. Without U.S. presence in NATO, Putin gets bolder and China sees an opening. Expect Russia to push harder in Ukraine and Eastern Europe, while China may escalate military posturing around Taiwan. That means new hot zones, and that's fuel for defense, energy, and volatility assets. 4. Energy markets get shaky. With NATO fractured, Europe could see higher dependence on Russian gas again, or at least rising fears of supply disruption. Traders should watch Brent UCoil, WTI USoil, natural gas ETFs like UNG, also energy stocks, ExxonMobil XOM, Chevron CVX, Shell BP L. If supply fears spike, so will prices. 5. Currency shocks. Here's the FX play. Short the euro to US dollar, and the pound sterling to US dollar. Both will be under pressure if NATO unravels. Go long on safe haven currencies like the Swiss franc, CHF, and Japanese yen, JPY. The US dollar, USD, may rise in the short term as a safety play, but longer term, if global confidence in US foreign policy declines, that could reverse. How to trade it? Let's move into tactical positioning. If you're a trader, this is what matters most. Go long. Gold, XAU/USD. U.S. Treasuries, via bond ETFs like TLT. Swiss franc to Japanese yen pairs. Defense stocks LMT NOC RTX. VIX or volatility ETFs, VXX. Go short. Euro to US dollar and pound sterling to US dollar. European indices, E. G. DAX FTSE. Risk-sensitive tech stocks. Emerging market ETFs. Trade CFDs for flexibility. If you're trading CFDs, you have agility. You can take long or short positions, use leverage, and respond in real time to breaking news. Platforms like crystalballmarkets.com offer tight spreads and allow you to trade all these instruments, forex, indices, commodities, and defense stocks all in one place. Don't sleep on this moment. Whether or not Trump pulls the U.S. out of NATO, markets are already pricing in uncertainty. You don't need a formal announcement, just sustained doubt is enough to move capital. And remember, the worst time to trade geopolitical shocks is after they've happened. The best traders position themselves early. So, what are you doing today to hedge tomorrow's headline? That's it for this episode of Financial Market Insights for Traders. I'm Sophia, and whether the U.S. exits NATO or not, the signal is clear. Geopolitical risk is back in play, and smart traders are moving now. Check out crystalballmarkets.com for more tools, strategies, and up-to-the-minute analysis. And as always, trade smart and stay sharp. See you next time.